In this new series of videos, I'll be going through the companies in the New Zealand top 50 to analyze some of these individual companies to see which one is worth investing in and which ones are not so much so. Hi everyone, my name is Henk, and if you're new here, subscribe to the channel for more financial videos and check out my social media where I post some articles on Facebook and some quick stock analysis on Instagram. So while I was going through the list of winners and losers of the most recent report season, fully expecting most companies to be doing extremely badly and posting losses, there's one company that kind of caught my eye that stood out to me, and its name is Ebos or EBOS. I'm pretty sure I'm butchering the name. I don't really know how to pronounce it, but regardless, I'm just going to call it Ebos. Ebos is an Australasian distributor of healthcare, medical, pharmaceutical, consumer, and animal care products. They provide healthcare logistics, medication management solutions, pharmacy management software, business software, and multi-brand pharmacy services. They also sell vitamins, minerals, supplements, herbal and fruit teas, as well as functional food including molasses and manuka honey. They also provide community-based healthcare services and programs and supply health products to public and private hospitals and other healthcare organizations. They also offer contract logistics services such as healthcare distribution, warehousing, and clinical trial management. In addition to all of that, they also have multiple brands of pet nutritional products, treats, cleaner products, grooming, and accessories. So basically, they are a huge company that does a lot of things in the healthcare industry. Their main pharmacies include Symbion and Pro Pharma, and their pet brands include Black Hawk and VitaPet. They are an extremely diverse company that covering many areas of the healthcare distribution sector with more than 3,000 full-time employees. In their latest earnings report in August of 2020, they posted a net profit after tax of over 162 million Australian dollars, and that is an up of 18% compared to 137 million over the previous year. They also had an increase in revenue by 26% to 8.8 billion Australian dollars compared to 6.9 billion Australian dollars in 2019. And this is particularly due to strong performance and growth in their healthcare and animal care division. Due to the essential nature of their business, they have been operating during the majority of the lockdown period, and they have not been as adversely affected by the pandemic compared to many other businesses. While many other companies are cutting or suspending dividend payouts, Ebos still has a total dividend of 77.5 cents per share for 2020, and that's up 8.4% from 71.5 cents over the previous year. This is good for about 3.1% dividend yield. This also makes them quite appealing stock option if you're into dividend investing. Over the past 3 years, their earnings per share has been growing by about 6.3% per year, and while it's not particularly high compared to some of the real high-growth tech companies, they are still experiencing a positive growth in a world where many companies are losing sales and contracting. Let's now take a look at their statistics on the computer. On the statistics page of Yahoo Finance for the Ebos group, they have a return on equity of 12.67% for the last 12 months. This is a fairly impressive result when compared to the industry average return on equity of 8.9%. They also have a current ratio above 1, which means that they have more current assets when compared to their current liability, which is again a good sign. Currently, they have a dividend payout ratio of around 70%, which means that 70% of the profit is returned back to their shareholders, while 30% remaining can be used for future developments. Their earnings have been growing by around 8.2% over the past 5 years, which means that they are still achieving a good amount of growth in their earnings despite paying out a relatively healthy dividend, which again is a good sign. Looking at the analysis tab, it shows that analysts are expecting around 10% growth per year for the company over the next 5 years. Now let's take a look at the price chart of the company shares. Now their shares has been trending upwards over the past couple months to reach an all-time high of $27 before dropping back down to around $26 recently. Now around the 25 to 25.5 area is where historically there has been a lot of buyers interested in this particular stock. So if you are long-term bullish on the stock, you might be looking for a potential entry point around that price area. In a recent intrinsic value evaluation by Simply Wall Street, they have estimated that the current share price for Ebos, with around $25.50 to $26 mark, is around 5% undervalued compared to their fair value price of around $27. But do take these analyses with a grain of salt and just kind of use them as rough guidelines. Overall, Ebos is a well-diversified company that has been posting consistent increases in earnings and revenue over the past couple of years and throughout the current global crisis as well. And they're also in a position to grow further into the future, even if the current situation continues on. Now, overall, I am fairly bullish on Ebos as a company and for the long term, and as a bonus, they pay out a pretty decent 3% dividend as well. Let me know what you think in the comments below, and if you're new to New Zealand stock trading, sign up to Sharesies for the easiest to use New Zealand companies trading platform using the links below. And as always, I will see you in the next video.